for gathering today. I'll just expand a little bit more on the topic of today's conversation because, like Carolyn said, I recently graduated with an MBA in sustainability from Bard College, where I focused my thesis around the topic of our panel today, really in the context of the rise of commitments from banks to reduce their impact on climate change. And many financial institutions provide significant financing to entities that emit significant amounts of greenhouse gas emissions like fossil fuel or steel companies, but banks will also play a unique role and a powerful one, accelerating the transition to a low carbon economy and meeting the global climate goals of a less than 1.5 degree of warming future, or the Paris Agreement, by providing capital towards sustainability innovations. So now banks are exploring strategies to mitigate their exposure to financed emissions or those emissions associated with their lending and investing activities, sometimes called Scope 3 emissions. And today we'll discuss the challenges around making such ambitious climate commitments. We'll discuss collaborative efforts towards building climate-aligned tools and emerging solutions that are building traction. So really looking forward to speaking with Davida Heller, Senior Vice President of Sustainability and ESG at Citi. We also have Jamie Martin, Executive Director of Global Sustainable Finance at Morgan Stanley, and Herve Duteil, Chief Sustainability Officer with BNP Paribas for the Americas. So these industry experts are leading the way through interdisciplinary strategy, innovative financial products, and the power of data analytics. So I'm very eager to hear their insights on existing technical guidance, the regulatory context, and the future of lending practices. So participants, feel free to introduce yourselves in the chat. And by way of introductions for our panelists, I'll actually turn to each of you and ask you to say hello, explain your role, and maybe give a high-level overview of the commitment that your organization has made in terms of climate impact or net zero, whatever direction that you're taking, and how did that commitment emerge? How is it currently framed? So Jamie, you're at the top of my screen, so maybe we'll start with you.
Great, thanks, Emma, and it's a pleasure to be here today with everyone. Yeah, real quickly, as Emma mentioned, I'm a member of Morgan Stanley's Global Sustainable Finance Group. We sit at the firm level and work really across Morgan Stanley's three main businesses: our Institutional Securities Group, which is investment banking, capital markets, sales and trading, research. We sit across Morgan Stanley Investment Management, which is our global asset management business, and then also Morgan Stanley Wealth Management, which is our network of nearly 16,000 financial advisors, plus now E-Trade, and really are tasked with working in collaboration with the businesses to deliver our sustainable investing strategy. We don't have clients ourselves. We don't make investments ourselves. It's really about that collaboration. We're generally a pretty small team in the scheme of things at Morgan Stanley. But yeah, it's our remit is essentially twofold, and climate really sits at the nexus of that. So the first thing we do, as I mentioned, is what I'm focused on is our products and solutions related work with the businesses, helping our clients, whether they're the world's biggest institutional investors, the world's biggest asset owners, or individual investors, express their views around sustainability in their investment portfolios, and also are really across asset classes. So that's our product solutions related work. And then we also do all Morgan Stanley sustainability reporting, disclosure, and various stakeholder engagement. So as a global financial services firm, how do we tell our story around our own sustainability journey? And yeah, this idea of climate, as Emma mentioned, certainly financial services firms play a major role in mobilizing capital to address the transition to a less carbon intensive economy. I think, COVID and the pandemic, when it first hit, there was some thought that sustainability might fall down the agenda, so to speak, but really I think the systemic challenge of a global pandemic, systemic challenge of climate, of some of the racial and diversity related issues, right? These are all challenges without borders, and there's systems challenges, and the system has to work together in different ways to come up with solutions. And so clearly, as banks are facilitators and providers of capital, banks collectively play a big role in that. In terms of Morgan Stanley's own commitments, we're committed to being net zero in our financed emissions by 2050. We joined the Net Zero Banking Alliance, leading up to COP in Glasgow in November 1st, which I'm sure we'll get into. And we're going to be neutral in our own, operations as a global financial services firm by 2022. But happy to unpack that as we go forward. Thanks.
Great. Thanks, Jamie. And thanks again for being here. Davida, how about you and your work at Citi?
Sure. Thanks, Emma and Carolyn, for having me, and really excited to be having this conversation with Jamie and Herve. Actually, similarly to Jamie, I sit in Citi's sustainability and ESG team. We essentially set Citi's global sustainability strategy and work very closely with partners across the business to implement the elements of that strategy and our initiatives, and working really closely to integrate ESG considerations across those businesses, including our capital markets team, our global wealth team, our commercial bank, trade, markets, advisory, across all those areas. And I think, as has been said already, the momentum around this topic is pretty incredible. It's inspiring. I think there's a lot of work to do, and we're really excited to, I think, build off of not only what Citi has done over the past 20 years, but across the financial sector. I think we're seeing a lot of the work that Jamie and Herve's companies and ours have kind of put into place and have built these building blocks that are now essentially getting us to where we need to go, and kind of helping to set that path. But we also, obviously, there's a lot of work to do. There's a lot of learning. So Citi has a global sustainability strategy called our Sustainable Progress Strategy. This is the second iteration, and it essentially is just our public-facing organization of initiatives and focus areas. So it's made up of 3 primary pillars with different work associated under those, including low carbon transition. So this is where a lot of our environmental finance activity lives. So we recently just upped our commitment to a $1 trillion sustainable finance commitment. This includes $500 billion towards environmental finance by 2030 and $500 billion towards social finance in support of the SDGs by 2030 as well. The second pillar is climate risk. Really, how are we addressing and looking at climate risk across our portfolio, our impact, as well as the impact that we are having on the planet, and then also our sustainable operations. And our commitment to net zero really kind of connects across that board. And we were really thrilled because our new CEO, Jane Fraser, announced our net zero commitment on her first day earlier this year. And I think it was a really important moment for our team and our colleagues across the firm, because it really set the tone and the importance of this work for Citi. So we also have a 2050 commitment for our financed emissions as well, and that work is underway with initial focus on a few high-emitting sectors where we'll be setting interim targets by 2030. And we have also joined the Net Zero Banking Alliance, which really helps, I think, to push forward our ambition and really hold us accountable as we look beyond those initial sectors to what will come next. We've also set a net zero commitment for our operations by 2030. So really working in tandem across the bank to really look at these areas of work. And it's been a real, incredible partnership. And I think, maybe we'll talk about it a little bit later, just to see how things are really shifting within the company, as well as we're seeing alignment and really long-term strategic engagement and really helping and working with our clients across their journeys.
Great. Yeah, thanks, Davida. Very exciting stuff. And how about you, Herve? What about your work and BNP's approach to climate?
Sure. Well, good afternoon, everyone, first of all, and it's a pleasure to be with you all. So I've created this role about over 7 years ago at BNP Paribas. I come from a very long background in capital markets and derivatives trading. And I really created this role. I can't say step into it because it didn't exist when I occupied the vacuum. But I really took it with a trader's mindset, which was really to flip on its head our approach to ESG of those last 15 years by the time, and to switch from a defensive approach to a business-centric approach, to see opportunities where we were seeing risk, and especially opportunities to adapt financing solutions that we have or that we had to optimize the funding of corporations when we were tying those financing back to sustainability initiatives or good sustainability performance. So that was the very beginning, actually, back in the early days of 2014. It was the very beginning of sustainable finance, or what we called shortly after sustainable finance within the investment banking division of the bank. I think that was my main contribution in this role. Otherwise, I won't go back over what my two peers just said, but the scope of my role basically encompasses all the above. But I haven't left my trader's mindset to always have a preference to push for business development than risk analysis. In terms of commitments, BNP has had over the last 10, 11 years a series of fairly avant-garde, I think, ESG policies, quite rigorous, not perfect, and it has pros and cons. Certainly, we can be internally or externally criticized sometimes for having too tough policies. But at least with hindsight, in a number of recent cases where we observe credit deterioration subsequent to certain ESG profiles, it has served us. So we in 2015, as soon as the COP21 was done, we committed to align our portfolios with the Paris Agreement. And from there on, we did actually step up in the toughness, I would say, of our ESG policies with, for example, exiting all oil and gas independents that were involved with shale oil and gas, starting from exploration, production, transportation, trading, and marketing. So it's pretty wide. In 2019 and 2020, the fourth iteration of our coal policy was basically we will not finance a single organization that still has one single remaining coal asset in the OECD or Europe by 2030, and the rest of the world in 2040. So these are examples of how we approached the climate topic, and the commitment we made as well to the Net Zero Banking Alliance was an important step, but far from being a first step, but rather the continuation, if you wish, of 11 years of scrutiny on the energy mix that we finance and the carbon emissions we do finance. Lastly, from an operational scope, we've been carbon neutral since 2017.
Wow, very, very robust and rigorous commitments from BNP. Thank you for that overview. So I'll dive into some more questions, and I invite all of the participants to also post questions there in the chat or in the Q&A feature as well, as you have questions for our panelists. And Herve, I may turn it back to you to discuss a little bit more about perhaps the Net Zero Banking Alliance or other collaborative industry efforts. So I always feel very impressed by the work that's going on amongst peers in this space. And why is that important? What solutions have come to you from peer and stakeholder engagement? And perhaps give us a bit of an overview of what the Net Zero Banking Alliance is.
Yes, so the Net Zero Banking Alliance is very important. More broadly, there is something called GFANZ, the Glasgow Financial, help me there.
I think Alliance on Net Zero.
Alliance on Net Zero, here we go, which is part of the race to net zero that was launched by Mark Carney for COP26. And GFANZ groups 4 coalitions. All in all, it's about over 160 organizations, financial organizations, maybe over 200 by now, actually. More than $70 trillion of assets in total. And it's split between the Asset Owner Net Zero Alliance that was launched about 18 months ago, the Asset Manager Net Zero Initiative that was launched last year, the NZBA that was launched in April, and just a few days ago, the Net Zero Insurers Alliance. It's extremely significant because, as you know, financial institutions do have leverage. So when a large corporates make a net zero commitment without naming them, it's fantastic. They're worldwide corporations. But when it's a financial institutions, we have thousands of names in our portfolio, and that will put a lot of pressure. Now, to your question, in terms of coalitions, we were a signatory of the Principle for Responsible Banking, which basically called for alignment of the business strategy with the Paris Agreement, among other things. And another thing is impact measurement and target setting. So the Net Zero Banking Alliance is one step further, I would say, to do that. And again, talking about coalitions, we were at the beginning of something called PACTA, because it's nice to have a goal, it's nice to set targets, but then you need to measure and align portfolios. And PACTA has been developed by a coalition of banks. It's a methodology to measure the alignment of banking portfolios with the Paris Agreement. And briefly speaking, the whole idea is to project 5 years forward the evolution of your portfolio sector by sector, starting with the most carbon intensive. So if you take the power utility sector, let's say between the known capex that power utilities may have announced, the announced plant closures coming up in the next 5 years, and your own internal policies, you can project the evolution of your portfolio and compare that with a climate pathway that's compatible with a net zero trajectory, for example. And so these are examples of industry coalitions, either to create critical mass to get there. And I think that's what's the most important in the NZBA. I mean, banks making net zero commitments alone, it's a great thing, but it's a little bit of a wishful thinking dream, I may say. But if we do it all together, then there is a greater chance to achieve it, because quite frankly, we can't achieve it without our clients achieving it. And for our clients to achieve it, we need to put pressure. And so we need to be all aligned. So that's really what coalitions are about, especially in the financial industry, what the NZBA is about. And PACTA, if you wish, is a little bit the mirror image in terms of providing the tool and methodologies to have at least one way to do that.
Yeah, great. Yeah, the PACTA tool is a really interesting tool. Excited to follow that development. Jamie or Davida, is there any comment or anything you'd like to share about peer collaborations or perhaps events or initiatives leading up to COP?
Sure, I'll pile on, and I'm sure Davida will have other acronyms to add. It's almost half the job sometimes is navigating all these acronyms and all the different work groups that they represent, they're all, pieces of the puzzle, so to speak. So I'll add another one, and I know Citi's involved as well, which is PCAF, which is the Partnership for Carbon Accounting Financials. I'm sure Herve and BNP are involved in that in some regards as well. But that's, again, every bank could theoretically have its own methodology on how they account for the carbon emissions in the portfolio. And that is not a scalable solution that can be adopted and ultimately regulated, which I think is going to eventually happen. And so it's our expectation that PCAF, which stands for the Partnership for Carbon Accounting Financials, which is, again, another coalition of banks that are setting the methodology on how you actually measure this, which, again, all these ambitious announcements are great, but unless you actually have a commonly agreed upon methodology to measure it that can be transported across different sectors, across different asset classes, across different geographies, it's a lot of talk, and action is going to be hard to follow. So we think PCAF methodology has the kind of robustness and the approach to eventually be adopted by the global financial institutions. So we think about that as the methodology. We think about the Net Zero Banking Alliance as how you ultimately set those targets and manage it, as Herve was mentioning. And then the TCFD framework, which perhaps is now the most well-known acronym, is ultimately how you disclose it and report on it. And so again, now we have those pieces kind of coming together, and that helps when you kind of paint that entire picture. A lot of this is about getting the internal buy-in with our colleagues across the organization at Morgan Stanley, and that, I think, helps bring the acronyms together in a way that kind of makes sense and comes sequential. And then ultimately it's a circle because they become kind of self-reporting, and there's a lot of synergies between all the acronyms as well.
I think Jamie and Herve covered all the acronyms, and yes, Citi is engaged with all of those. I think what Jamie and Herve both touched on is, this is a journey. This is a long-term journey that we're all on, and obviously we're all doing it in our own way based on our different businesses. But these coalitions, these spaces for us to engage and kind of look at how we're measuring, how we are, collecting data, how we're looking at the data, how we're looking at the fact that we don't have the data that we need. I think that these are all really important steps, and these, whether it's, TCFD, PCAF, PACTA, these tools, they kind of set the playing field so that, as Jamie mentioned, we're not all, we're all going to have our own way, our own plans, but at least we're somewhat kind of, following the guides. And so it's as, it's as close as we can get at this point to an apples to apples, and we're not, because otherwise it's almost futile. Like we need to be able to understand really what our individual and collective impact is.
Yeah, absolutely. Yeah, thanks for that. And Jamie, I was already kind of planning to target a question to you about technical methodologies and, what kinds of analytical tools you're exploring. So from what I understand, that the tools that you've mentioned, are these more for Morgan Stanley as an organization for measurement and analysis, or are these more based on analytics that you might engage with clients or who you're working with to accelerate their own strategies?
Yeah, I think it's a bit of both. I mean, I do think the PCAF methodology, and again our net zero finance emission, I mean, that is about the financed emissions that happen on Morgan Stanley's own balance sheet. There's this other almost challenge, I guess I'll call it, which is about the facilitated emissions that a bank is involved in. So, we do a lot of financing that doesn't end up necessarily directly on our balance sheet. And, you could argue, I think justifiably, that Morgan Stanley, should count that, and other banks should as well. I think there's kind of a little bit of an open debate on that at this exact moment. But I do think, again, for this to really work, we also are going to have to embed the metrics in the transactions that Morgan Stanley, either underwrites or finances as well, right? And so, at this point, it's hard for us to come to our clients and mandate a very specific, carbon either measurement or in many cases estimate, because again, it's difficult to really capture this data with 100% accuracy unless you're kind of at the source. But like just by way of example, PCAF has its own working group for green bonds. And so all of our collective organizations are large underwriters of green bonds. To date, there's no one's forcing anyone who issues a green bond to disclose or ultimately report in the impact report of the green bond the avoided emissions or the quantified emissions associated with that particular green bond. Now, again, as this all transpires in the journey that Davida mentioned you could see that becoming best practice within the green bond disclosure framework. Some of it's starting to happen organically, but Morgan Stanley, Citi, BNP, we have a lot of collective power, and we could, basically say, if you're going to come to us, we're going to underwrite your green bond. We want to make sure that you're doing this and you're giving us ultimately the information that we can then feed into our, carbon accounting methodology. So again, that's just one very small example, right? I mean, green bonds remain a micro fraction of the overall, global fixed income market, which is the biggest capital markets market globally. But again, all the banks are now touching it, and they have power, and they are ultimately issuers are looking to banks for advice on what the best practice is, and we can start to really set the standard, and then it will obviously, hopefully, at least evolve from there. So that's one example. And yeah, I mean, we can talk about the data and analytics maybe from like an investing lens, which is something we spend a lot on as well. I mean, again, ultimately, how do you properly identify the climate risk and the climate opportunity in the investment portfolio? Is very complex analysis, but there are, again, kind of best practices and new tools that investors are engaging much more robustly than ever before.
Yeah, thanks for that. It's a great example. Herve, would you add anything about analytics that you're looking at or tools that you rely on in addition to PACTA and others?
No, not really. I mean, it's a vast topic. We have a massive data initiative that has been going on now for close to 3 years, and financial institutions have many more parameters to integrate. And as we know, systems are very complex in financial institutions. So getting the data is one thing. Integrating it within systems is another one, and it goes hand in hand. Maybe the comment I would make, however, is, and if I may challenge a little bit, Davida said it was a journey. I'm afraid it's a race, in the sense that we don't have the luxury of time. And so from my perspective, I don't think we have the luxury of getting the perfect on the data, because we don't have enough time, unfortunately. At least the decision time frame to make the right decision to eventually get to net zero by 2050 is very small. It's in my mind, it's like 3 to 5 years max, because we need to be at a certain place by 2030, which means we can't start in 2029. So we have more or less the next 3 to 5 years to make the right decisions. Obviously, if we make them in 3 to 4, 5 years, we will have to make greater decisions. Greater ambitions. So we need to find the right balance between accuracy and what we need to, even if it's an imperfect measure, it's enough to create action, to benchmark, and set targets. So I think that's the challenge, in the sense that we don't have enough time for the scope of what is needed, and so we need to find shortcuts on which we need to collectively agree, so that we can continue to move forward. Because of course, since it won't be accurate and it won't be perfect, people can legitimately disagree. But then if we don't find a compromise, we will miss the target.
Right. Yeah. We will all be very busy in the next few years on this journey and this race to solving the climate crisis through green finance. And Davida, I think I'd like to hear if you have other comments on the analytics piece, but I was also curious to hear from you about, as you're setting interim targets and heading towards that colossal goal of green financing, what kinds of financial products and innovative financial products might be coming on the horizon that we should pay attention to and that Citi is exploring?
Yeah, absolutely. I think it's a really exciting time for innovative financial products, and I absolutely agree with Herve that we cannot wait. And I think that the the net zero commitments that we've seen practically from all financial institutions at this point are really pointing to the fact that it's we can't wait, and we have to work with what we have and continue to evolve those processes as we're in them, rather than waiting for them to be perfect, because otherwise we will run out of time, and we can't wait that long. I think for us, what's been really interesting is this is our kind of third or fourth target, depending on how you look at it. We started in 2007 with a $50 billion climate initiative, and then we had a 100 billion environmental finance goal. And last year we set a 250 billion, and then it expanded. The difference with this is we've always set an ambitious target. We always did projections with our banking colleagues. This has always kind of been an all hands on deck, but to be completely honest, it has been BAU the past, the first two, I would say, in the sense of just growing and understanding and starting with communications processes and understanding, well, what is this activity that's actually happening? And this is really this recent target, we do not have line of sight for how we will achieve it. We will not achieve it if it's just BAU. And I think that, in conjunction with the client engagement that's happening around net zero, where we really are engaging with clients on their transition plans on, at a different level, I think, and really working with them to achieve their sustainability goals. And then also, really looking at, trying and working towards defining transition finance, and really looking at, yes, we have green products, and we do not want to risk those reputationally in any way, but we do need to identify transition. And I think, Herve, I think you've actually written a number of articles on this topic, actually, maybe a year ago or so, just the importance of this as an asset class, and really looking at what, how do we work with those clients that are maybe in higher carbon intensive sectors, and really working with them to transition, and recognizing, well, how do we measure that? What does that look like? In addition to obviously having green and sustainable finance. I think we're seeing a real growth in KPI linked financing. So kind of turning from use of proceeds and actually looking at how are we linking capital to performance, like company performance. We're seeing it in the loan space. We're seeing it in the bond space. I think we're starting to see it in, supply chain finance, and really looking at how are we working with our clients to incentivize activity and reduction in emissions across their supply chains, but really looking at, what are these KPIs, and working within the guidance that exists, but really identifying, okay, what is material to our clients? What do they need to achieve in their individual sectors and industries? And how do we ensure that there is a level of ambition, to avoid greenwashing? And so, but I think that the KPI linked product is really interesting, because it's also allowing new companies and entities to enter into a market where, the traditional green or social or sustainable bonds might not have been an option for them. And so really kind of focusing more on how do we improve our performance in order to actually get into this conversation is one that I think we're seeing a lot of activity. I'm sure Jamie and Herve have other examples, so I won't monopolize, but I think that, as far as towards our target, we're seeing things like that emerge, and really, partnerships between our banking teams and our clients, and really looking at how do we help you along all steps of the journey, and really looking at those opportunities rather than just, one-off transactions.
Yeah, that sounds great. Jamie or Herve, would you like to add your perspective on approach to products?
I may add a complementary thought. I totally agree with everything that Davida said. At the same time, I would say, so you're going to see, of course, ESG products taking over and growing. And I would say, in a way, taking a back seat in terms of impact. By that, what I mean is, it's not because you incorporate credit rating into products that you improve the credit of a corporation. So I think ESG and sustainability linked structures are becoming the new way of doing financing. But we're moving from, over the last 7 years, it was, in a way, we were showcasing the best in class. At least through the conversation and the focus it brought, those products were having impact. Now, it's becoming more the minimum standard, if you wish. So incorporating ESG is becoming more and more the norm, as demanded by lenders, whether they are banks or investors. But I think now the real challenge is this net zero transition, getting capital truly flowing towards transformative, towards sustainable transformations, if you wish. And I think many sustainable finance products are fine. I mean, they are sustainable, but they're not necessarily financing a powerful transformation. So it's in that sense that I think ESG products are going to become the norm, but they're going to become the vernacular. And the real challenge now is how to go one step further, and from good sustainable companies, we move to transform a number of business models, because there are a number of sectors which are not there yet.
Yeah, I would just pile on again. I mean, I agree with the transformation and the innovation that's happening. And I think just, again, reiterate the foundation that needs to exist first, which we spend an enormous amount of time on, which is just purely education and helping people understand what all this is. And ESG is not just one thing. There's lots of different approaches, obviously, within ESG, which is a panel in and of itself. But I think there's internal education to get people equipped to be proactive and playing offense on these topics with these clients, where they're investment banking colleagues or capital markets colleagues who have obviously deep relationships with the very senior decision makers in the world's biggest companies, right? They need to feel that they have the knowledge and the foundation to come to a place like Morgan Stanley or Citi or BNP and feel confident that the advice we provide will get them to where they need to go on their own journey. And all the companies are obviously at different stages of adoption. So it's very, the knowledge distribution of all this inside these massive financial services firms is just a real challenge, because banking at the end of the day remains a relationship business. It's and these relationships are what our organizations are built on, and you got to get people up to speed quickly on, as we've mentioned, a topic that is moving incredibly fast. So yeah, I think as there's more coverage in the mainstream financial press around these topics, it used to be hard to find some of the information. All of our sell-side research organizations are writing I think probably prolifically about how the transition is going to impact different sectors and kind of in different macro scenarios as well. So it's happening, but I think at the same time, yeah, our groups kind of in the center of our own internal organizations played a key role in trying to accelerate that. And then again, I think as mentioned, banking by its nature is competitive, but I do think this is more about that, co-opetition and working together. Companies come to banks for different things. We're often on the same types of deals with different roles. And again, it's about, again, trying to all row in the same direction for this to really continue to accelerate at the pace that really needs to happen to actually reach these goals that are way out in the future.
Emma, can I just add on to something that Jamie said actually earlier? Jamie was talking about the impact of COVID and the tragedy of the pandemic, and that moment where I think many of us were like, oh, is sustainability and going to be, kind of pushed to the wayside as it has been, before with like the financial crisis. But I think what we saw happen, to what Jamie mentioned, is this incredible rise of understanding or understanding of the need to incorporate the S and the alignment and importance of actually the E and the S connected, where for so long, I think, because for a number of reasons, really, just because I think environmental impact has always been a little bit easier to measure and define. And we just, for a lot of the banks, especially the three here, that's where we all started, but I think there's been this weird kind of, there was a weird misinterpreted competition. Oh, well, if we're focusing on environment, you can't focus on social, vice versa. They're separate. And I think what COVID has created is an opportunity where we've really seen the financial sector work with our clients to really connect those two. And I think now we're seeing the importance as we move forward with these net zero commitments, our climate commitments, our, all of this, that the S and the E are actually, very aligned and need to be taken into account. And I think that's also I don't know, I wouldn't call it an innovation, I guess more of a realization that we're all kind of taking forward, which I think is going to, even increase opportunity, which we're starting to see globally.
Yeah, thank you for that. I think it's such a great observation and a really important point. Well, we are in our last couple of minutes together, and thank you to our attendees and participants who have already submitted some questions and comments in the chat and Q&A. And there's a couple of questions around standardization, reliability of disclosed information, and we did discuss earlier a little bit, we touched on policy and emerging policies. So curious to hear from our panelists from both the United States perspective, but also globally, what are those emerging regulations that you're paying closest attention to and that are going to impact and hopefully accelerate this work the most? And happy to start with anybody who has some thoughts at the top of mind here. Davida, go right ahead.
I can start. I mean, that's a big question. We can actually probably have like a full hour on that, a minute piece of that alone. But I think Europe has clearly been leading in this work for a very long time. So I think there's a lot of interesting regulatory impact that we're watching out of the EU. And I think as we see the EU taxonomy develop, what impact and the need to report, and obviously TCFD is requirements there. But I think what's from a US perspective with the SEC and really looking at, well, what is going to be required from a climate disclosure perspective. I mean, I think we're seeing the United States reposition itself and take accountability. And I think we are looking at, what will disclosure impact have for us? And I think, we've all known this was going to happen at some point. But I think the climate disclosure piece is really the biggest, and we're kind of seeing how that will differ in different jurisdictions, and that is important, but I think we have to, there can be a lot of confusion there. So it'll be interesting to watch that space.
Jamie or Herve, different comments about policy?
It's so on the EU side, it's both inspiring and incredibly complex. The level of reporting complexity is quite impressive in some ways. At the same time, that's what will help us. What will help push us forward globally, I would say. It's clear. Second point is that it's clear that regulation is coming, that disclosures are moving from voluntary to mandatory. I think the main issue is more how fast, and I don't mean in this. What I mean is we need this as quickly as possible to again have a chance to make the right decision within the time we have left to make those decisions. And maybe the third and last point is the point to watch is how quickly we can align those various regulatory moves. There is a very interesting initiatives launched by the IFRS with the support actually of the five main standard setters to come with some globally recognized standards on climate and ESG reporting. But the question is how quickly we can align this and get some minimum on which we all agree, and especially from a quantitative standpoint. We've seen the limitation of voluntary, fully non-prescriptive disclosures. In fact, the SEC had climate disclosure guidelines, which are pretty comprehensive since 2010. And today we don't have what we need overall. So I think we need to agree on some basic, albeit crude metrics, so that we can aggregate and compare globally corporations in this race. And so just to close on regulations, it's moving, it's complex, but what we really need to look for is some basics agreed internationally.
Yeah, absolutely. Jamie?
Oh, I think all of it was very well said from Davida and Herve. I think, yeah, I mean, again, this is market infrastructure is all being rewired, so to speak, to start to integrate ESG and climate. And I think, again, as mentioned, Europe is out in front. You know, the SFDR, which is Sustainable Finance Disclosure Regulation, is, you know, essentially mandating that, you know, asset managers categorize their funds, and if they're not robustly doing so, and to avoid, you know, greenwashing either in reality or the perception thereof. And so if you're an asset manager and you sell product in Europe, you have to adhere to that, even if you're based in the US. And so our observation is some of the US asset managers still don't quite realize just how comprehensive and how cross-cutting and deep, as Herve was mentioning, this regulation is. And so I think, you know, that some of that, you know, is going to start to get ported over here as well. We'll see what parts kind of make it. But I think, again, if you're a big global asset manager, you know, you're going to kind of, and you're looking to skate to where the puck is going, or whatever sports analogy you want to use, I think, you know, you're going to set your bar based on the most stringent regulatory guidance. And so I think, as mentioned, that will have a big time effect on how these products get categorized and ultimately evolve to actually, mobilize the capital to get to the positive outcomes that need to be invested in and occur.
If I may add one point, an interesting thing to watch, actually, there is a tug of war between two camps. The European camp that is really calling for reporting on what we call double materiality, and another camp that would like to mostly focus on financially material, let's say, financially material climate-related risk, let's say. And what we call double materiality, it's ESG risk or climate-related risk that can have an impact on financials, but also look at risks that do not have necessarily an immediate impact on financials, but that do have an impact on society or the planet or whatever. And what is interesting to note is that investors, including in the US, do care about both. You have this, you hear this debate about only financially, the SEC should only focus on financially material related disclosure. But the reality is, when you look at the recent proxy battles that have been launched, what investors have cared for and even won against the recommendation of the board, like, for example, disclosing lobbying activities that may not be aligned with, or at least alignment of lobbying activities with the Paris Agreement. You could say it's not financially material, yet investors do care about this to the point that they launched a vote and even won the vote against certain flagship companies. So that's a very interesting point to watch, whether the minimal standards will only relate to financially material issues, or whether it will broaden the scope, and that would be very interesting for the future of finance.
Yeah, absolutely. Yeah, what a great point to end on as we come to the top of the hour.